Hello guys, welcome back to another lovely trading video. In this one I'm going to be showing you my strategy and how I'm personally trading the market when we're a bit more bearish or direction is unclear, because obviously the last few years has been quite easy. Markets have just been in quite a strong uptrend now. We have had a few months of red. July was actually positive, but apart from that it has been quite weak recently. So when direction is unclear, how can you trade, or how am I personally trading to kind of combat this downwards market? Because my strategy is a bit different to how it was in the bull market, and really we are trading the same sort of setup. It's just how we're executing the trade that has kind of changed. So we will be going through and going how I use everything on Think or Swim, because this is where I do all my charting. The only difference is I now do my orders through Tastyworks, and the reason for this is when I'm trading this kind of market I'm more options focused, and Tastyworks tends to just be a bit better for trading options. But to get straight into it, the strategy, like I said, is quite similar to really what I was using and have been using since this channel has really been created, and even before then, and that's just using standard deviation channels. So this strategy is mainly technical focused. We will somewhat be looking at fundamentals, and we will kind of go through when we're looking at the fundamentals, but this is mainly a technical based strategy. And all I personally do is have these standard deviation channels on both a 4-hour 180-day chart and a yearly chart, or a daily chart, which is a year. And all we do is go over to go to studies, add studies or edit studies, and all I have is standard deviations going from 0.5, 1, 1.52, 2.53, 3.5 and 4. And the reason for this is this will kind of create these standard deviation channels, as you can see here, and they tend to just be very good insights into when pressure should come in, or just buying or selling pressure should come in. And so really looking at these deviations, you do tend to see quite strong bounces, as you can see here on PG. Whenever you're kind of coming into these deviations, tends to be where they move. One thing to take into account though is if you're back testing this strategy, you do have to go to the on-demand mode, because the reason for that is standard deviations change on a daily basis, or at least on the daily chart they change once a day, and the 4-hour chart they do change every 4 hours. So if you go back a month, these deviations will slightly be different from where they are now, so they may not have hit each line so accurately, but either way we're just looking at it in current time. So that's all fine for now. And all we're really looking at is, so you can see these golden deviations are the first deviations. And if you understand how standard deviation works, 68% of the data should trade within these first deviations. And then you go on to the second deviations, which are these blue ones, and 95% of data should trade within these. And then you go on to the third deviations, which are the green ones, and 99.7% of the data should trade within it. So that's what should happen. Obviously it doesn't always happen, and that's why obviously in trading nothing is 100%, but it's at least shown me enough actually that it does work in normal markets and even kind of these weaker markets. And so all we're going to be really paying attention to, most of the time we're not paying attention to these first deviations, and the reason for that is, like I said, 68% of the data trades within it. But that does also mean 32% of the data trades outside of it. So it just means normally it's not going to be as accurate as going on to the second or third deviations. And then you may be wondering, what's this red deviation? That is a fourth deviation. And on large cap stocks, which is kind of this strategy that we're going through today, you're not really going to need it, because mainly large cap stocks aren't going that far from their statistical mean. That is more for if you're looking at the kind of day trading stocks, momentum stocks. You can see down here, the gap fills, which are moving 50, 100% in a day. Then they can sometimes push out of that third deviation, maybe to a fourth, and that can just be another area to short it. But overall, in the large cap side of things, you're not really going to have to ever use that fourth deviation. So if you're only going to be trading large cap, no small caps, you don't even really need to add the 3.5 or the 4.0 on. So now everything is set up, and this is how we're looking at it. Like I said, we're really going to most of the time just ignore this first deviation and instead wait for that second or third deviation. And then what we're going to really wait for is, coming into these second deviations, is it kind of tells us that we can be a bit more long bias on the stock. So you can see we have our second deviation at 136, another one at 130. And then we have our third deviations at 129 and 122. So seeing these are kind of 4 levels where we would be quite happy looking at PG and maybe getting long. And so really how we would trade this, and may even trade it when it comes into this level now, is saying that once PG comes into this 136, we're then looking to go into the options. And what are we looking to do with these options? So I'll go over here, and the main strategy we're looking at is call vertical spreads. Another name is debit spreads, and there may be other names of it that you may know it by. But all we're really going to be doing is going over to the call size, because in this instance we're more bullish on it because it's coming to a lower side deviation. So if we're buying at the 136 or the 130, whatever that is, we're expecting the stock to go up in value. So we would go over to the trade and we would be looking at our calls. So in this case, that's on the left on Think or Swim. And what we'd be going to do is whatever the current value is. So obviously we're looking to buy this when it's at 135, or sorry, 136. So what we would really be looking to do is buy the more expensive call. So in this case, that would be the $135 call. And then you're looking to sell the strike below it, which in this case is 140, and it's the cheaper one. So you sell the cheaper one, you buy the more expensive one, and that is why it creates a debit. And all a debit means is you have a max loss, and you're kind of paying to this trade right now. So if you were to enter this trade right now, you're basically, in this case it's costing $295. You're going to pay that $295 and it's going to be out of your account until you close the trade. Whereas if you did it the other way around, for example, buying the cheaper one and selling the more expensive one, that would create a debit spread or a credit. Actually, I think that makes it more of a bearish play. But if you want to look into credit plays, you can look elsewhere, because we're mainly just going to be trading debit spreads right now. But yeah, so this would create a bullish option or bullish call on PG, and it would cost us in this case $295. Now, what would your max win be on this? So as we said, our max loss would be $295 per one contract that we buy. So obviously we can then go and buy 5. And then our max risk would be close to $1,500. But if we were just buying one, as in this case, that would be a max risk of $300, or about $295. And then what does that mean our upside is? Well, all you have to do is look at the difference between the strike price. So in this case, 140 minus 135, which would be $500. Take away the $295. So that would provide us with $205 as our max profit. So in this case, obviously, it's not even a one-to-one risk to reward, which is just happening mainly because we're not actually at the current price. So if I was to show you this option again, where we are currently in the money, then we'll do that the wrong way around. Then you can see it's much more closer to a one-to-one risk to reward. So in this case, our max risk is around $230, which means our max win is around $270. And that's usually what it will be. Usually this trade will be a one-to-one, near enough a one-to-one risk to reward. And so yeah, really that is the main setup. We're looking to buy the more expensive one, sell the cheaper one at its kind of current price. So again, if the current price right now was at $135 and we see our second deviation is at $135, that's when we're looking to get long. So really we would be looking to buy the 130 call and sell the strike above. So again, in this case 140, and again that will be quite close to a one-to-one risk to reward. Now, how do you make money then in this trade? So there's 2 ways you can really look to close this trade out. So firstly, you can see how long is it looking to expire. So in this case, we're looking at the 18th of November 2022, which is 111 days into expiry. So if we were looking to not touch this contract once we buy it, all this would mean is as long as PG is above $140 come the 18th of November, then you would be at your max profit, which would be $205 in this case. Now, if you were between $135 and $140, you may win or lose some money. And you know, if you're close to the 140, you'll probably end up making money. If you're closer to the 135, you're more likely to lose money. And if we close below $135 on the 18th of November, then that would be your max loss of $295. So that's how you can trade it to expiry. And sometimes I will do this, but in this kind of market, a lot of the times I'm not really looking to trade to expiry. And this was something I would do more in a bullish market, and you know, you could get long on your calls or long on the stocks, and you would expect them to kind of keep going, so you could kind of just let them go to expiry and get your max profit. But instead, in this kind of market, what approach I'm more taking towards it is kind of closing them early. And to kind of show this, I will put up some of the trades I've done on Tastyworks. I think these have been like the last 30 days or so. And so you can see here that we're on PG now, so PG is a good example. We bought a debit spread for $2.20, so in that case, you know, we're paying at a max risk of $220. And so if we go over to the chart, I did think we bought this around this area here. I think it was posted a while back, because I think we posted when we were looking at the trade. If not, it was definitely in the Discord. But we were looking at it as it was around $132, I think is when we entered. And so we bought the 130 and the 130. Oh, well, sorry, we bought the 130 call, we sold the 135 call. And so really, if we were looking to hold it to expiry, as long as it was above 135, we would have made our max profit. But that would have been around September time, so you know, next month, 2 months away. And so by then, PG may come back to this 130 mark. As you can see, it's had a sharp sell-off. So if it did do that, we would have been quite high in profits, and then there's potential that we can lose all that profit. And so that's why in this kind of market, when there is a lot of volatility, we don't know whether the stock's going to go up or down, I tend to close these trades out early. And by doing that, let's say we're buying at this second deviation, really my target's going to be near the statistical mean. And in this case, that's 145 and 151. And how I will pick which one is my target is whichever one is closer. So if we're getting long at 130-ish, the close one out of the two statistical means is 145. So really, we're going to be looking to lock in profits as we come into this level. And how do we lock in profits? So really, all you have to do is just do the reverse of the trade. And so all that would be doing is selling the more expensive one, and then buying the cheaper one, and that would then create a credit, which would then close out your trade. Because you obviously open a debit, you need to close it with a credit. And you can see how we traded this was, we bought it for 220 when the chart went up. So again, we bought it around 130 as it was coming towards this 140, 142 area is when I was looking to lock in profits. So then if we were looking to close it as a credit, we could close it for $321, which does mean then that we made $101 on this trade. Now obviously that does mean our max risk taking it was 220 and we only made $101. That may not seem always worth it, but now what is the benefit of trading like this in this kind of market is, well, again, we have, let's say in this case, 111 days to expiry. So really that, as long as our stock rises above where we bought it at, within those 111 days, you'll usually be within profit. So if it comes towards what my main target is on PG, within those 111 days, I may as well close it early, because then I can guarantee the profit, lock it in, make that $100, and then there's no risk of me losing that $295 or $220, I think, in the example I gave. And so that's really the main way we're trading it. So in this kind of market, again, all my trades are usually less than a 1-to-1 because I'm closing them out early. But it does mean you have a very high probability win chance, because it just means it has to go in your direction within the next 110 days, which is quite likely unless a major event happens and all the stocks kind of sink. But that is really the main trading strategy. So I do hope that makes sense. If it doesn't, leave any comments and I will get back to them. And if it's not clear, let me know which parts weren't clear, and then I will make an updated video covering those bits if it can't be replied to in the comments. Now, hope you enjoyed the video, hope to see you next one, and that's it. Peace.
And maybe I'm crazy.